There is a strange moment that happens when money starts to accumulate, not when you become rich, not when your life looks different from the outside, but earlier than that. It happens the first time you realize the bank is no longer treating you like a possible mistake, because banks do not relate to people the way people think they do. They do not see effort, they do not see discipline, they do not see the nights you stayed in, the overtime you worked, or the months you spent trying to get ahead. They see patterns, they see balances, they see risk, they see opportunity, and depending on what those numbers say, the same institution can feel like a wall, a vending machine, a concierge, or a private club. At the bottom, the system is mechanical. Your account dips too low and the penalties arrive fast. Not because anyone inside the bank hates you, that would almost feel more personal. No, what hurts more is that nobody has to hate you at all. The charge is automatic, the fee is standardized, the explanation is scripted, and when you call, you are not speaking to a person who knows you. You are speaking to a process designed to handle volume. That is what low-balance banking feels like. Not drama, not scandal, just cold, efficient indifference. A small mistake becomes an expensive one. A delayed payment becomes multiple fees in different places. A short-term shortage grows into a chain reaction. And what makes it brutal is not only the money, it is the feeling. The feeling that every inconvenience costs more when you can least absorb it. The feeling that institutions are most rigid with the people who have the smallest margin for error. The feeling that the system is telling you, without ever saying it directly, that being financially fragile is itself a punishable condition. Then something changes, not all at once, not dramatically, but enough to notice. Your income becomes regular, your balance stops swinging wildly, you keep a cushion. Maybe not a life-changing amount, but enough that your account starts to look stable. That stability matters more than most people realize, because once the bank sees predictability, your experience begins to soften. Certain fees disappear, approvals become easier, offers start arriving. Nothing about you as a human being has changed overnight. Your character did not transform, your intelligence did not suddenly improve, your potential was not discovered by a committee. What changed is that the bank now believes you are statistically easier to work with. That is an important distinction. People like to imagine financial institutions as moral judges, as if they reward virtue and punish irresponsibility. Most of the time, they are doing something much less emotional than that. They are sorting. They are constantly sorting customers into categories: expensive to serve, cheap to serve, likely to borrow, likely to default, likely to stay, likely to grow. Once you move out of the most fragile category, the tone shifts. You begin to receive what looks like trust. But often it is not trust, it is commercial interest. The bank is not embracing you because it finally sees your worth. The bank is embracing you because you now fit the profile of someone who can hold products, carry balances, repay loans, and deepen a relationship over time. You are no longer a problem to process. You are a customer to develop. And then, a little higher up, the experience changes again. This is where banking starts to feel personal. Maybe you get a direct contact. Maybe a banker reaches out. Maybe a fee gets reversed without a long argument. Maybe your loan terms improve without you begging for them. Maybe somebody remembers your name. These things feel small until you remember what life looked like before them. Before, the system made you wait. Now it follows up. Before, every exception felt impossible. Now exceptions appear quietly, almost casually. Before, the answer was policy. Now the answer is, let me take care of that. That phrase matters because it reveals something most people never say out loud. Rules in banking are often strictest for the people with the least leverage. The higher your value to the institution, the more flexible the institution becomes. And flexibility is one of the most expensive luxuries in the financial world. The ability to get a person instead of a menu, the ability to solve a problem in one call instead of 5, the ability to have context carried from one interaction to the next. The ability to receive better pricing, not because you fought harder, but because your profile unlocked it. This is when people start believing they have found a good bank. Sometimes they have. But often what they have really found is a better seat inside the same machine. Keep moving upward, and the relationship becomes even more revealing. At a certain level, banking stops feeling like storage and starts feeling like strategy. You are no longer being offered only checking accounts, credit cards, and routine loans. Now the conversation expands. Liquidity, tax efficiency, portfolio structure, real estate financing, business credit, succession planning, trust structures, access. Access is where the air gets thinner, because once you enter the world of wealth management and private banking, the institution changes its posture completely. You are not merely using the bank anymore. The bank is now positioning itself around you. Meetings happen on your schedule, calls are returned quickly, problems move faster. People with titles enter the room, products become tailored, minimums become negotiable, terms become discussable, and this is the part that unsettles people when they first see it clearly. The difference between mass market banking and elite banking is not just nicer service, it is a different philosophy of relationship. At lower levels, the system asks, how do we standardize this customer? At higher levels, the system asks, how do we keep this person? That single change produces an entirely different universe, because once retention becomes the goal, the institution becomes more attentive, more adaptive, and more generous. Not generous in a moral sense, generous in a strategic one. The same bank that once charged heavily for inconvenience may now waive costs without discussion. The same bank that once offered generic products may now present custom structures. The same bank that once hid behind policy may now bend around preference. And at the very top, the relationship crosses another line. Now your money is not just something the institution holds, it is something the institution organizes around. Your presence matters internally. Your business affects incentives. Your needs can influence what gets prioritized. Your departure would be noticed. This is not ordinary customer service anymore. This is status translated into operational reality, and that is the real lesson behind all of it. Banks do not become kinder as you become wealthier. They become more responsive as your financial gravity increases. That is different. Kindness is universal. Responsiveness is selective. The institution did not suddenly discover empathy at the top. It discovered importance. And maybe that is the hardest truth in the entire system. If you have ever felt ignored by a bank, you were probably not imagining it. If you have ever felt oddly welcomed after your finances improved, you were probably not imagining that either. Both experiences can be real. Because the machine is calibrated to treat different levels of money as different levels of significance, not different levels of humanity, just significance. And that distinction explains almost everything. It explains why penalties are heaviest where resilience is weakest. It explains why convenience becomes easier to buy the less you need it. It explains why people with modest means are often managed by rules, while people with substantial assets are managed by relationships. Same logos, same branches, same app on the phone, different experience, different speed, different access, different margin for error. So when people say money changes how the world treats you, this is part of what they mean. Not only restaurants, not only travel, not only housing or healthcare or education, banking too, especially banking. Because banking is where the system quietly reveals what it values most: stability, assets, predictability, and profitable relationships. And once you see that, it becomes hard to unsee. The person with very little money and the person with a great deal of it may both technically be customers of the same institution, but they are not standing in the same reality. One is being processed, one is being managed, one is being advised, one is being protected. That is the latter. And the unsettling part is not that the latter exists. The unsettling part is that the bank does not hide it nearly as well as people think. It shows up in fees, in wait times, in approvals, in tone, in who gets a script and who gets a direct line. So if banking ever starts to feel personal, remember this: it probably isn't personal, It's financial, and that may be the most honest thing about it.